Hey, everybody, and welcome to your next. I'm your host, Jerome. Man, this podcast is international. It's been international for a while, but today we're in Madrid, Spain with Juan Ignacio. Juan, how are you, brother? Good to see you.
Doing really well. Yeah, thank you for hosting me, Jerome.
It's a pleasure, man. It's good to be able to share your story. I think so many people are going to be inspired on the back end of it. So, you know how I open up these shows, man. You had an exit, huh?
I did, yeah,
Tell
I
us a
did.
little bit about it, because the international exits are always, I feel like they've got hair on them because it just feels like the Wild Wild West to me. But it's just probably my lack of familiarity with it. So tell me a little bit about the company you built and your exit.
Sure. Well, first of all, before I started my company, I was a co-founder for a ride-hailing platform in Spain and Latin America. So I was a co-founder there. I was the CFO, but I wasn't kind of behind the wheel, which is what I wanted to do, right? I wanted to be the pilot rather than being the co-pilot. And I went on to found a lending platform. I went straight to the US. I thought that was the market that was most suited for the type of business that I wanted to build. And so essentially, what we did is lend on B2B SaaS companies, mostly backing smaller operators, less than 5 million in revenue, so that they could either fund working capital or, in most cases, a large investment, which would mean acquiring a competitor, acquiring assets, taking the company to the next level. So we partnered with M&A marketplaces and brokers like Acquire.com, Empire Flippers, and so on. And I actually ran the business from Madrid, even if all of our customers were in the US and all the business was carried out in the US. That was 2021 when I founded it. 4 years later, 4 years later, I was exiting.
No.
That's how it went. Yeah, and it was a roller coaster. I can tell you, we grew really fast, but then in the last couple of years, growth stalled a little. It was really hard to raise capital, which was a fundamental part of our business, given that we were in the capital deployment space and lending to all these smaller SaaS companies, and that's where I decided that we needed to be part of a larger platform.
And so your deal, did you have an earnout? Did you have to work for the acquirer? Like what? How is your deal structured?
I don't think I can fully disclose it, but yeah, it was mostly, I would say, almost on the land of acqui-hire. We got obviously, some funds for our investors and for ourselves. We had to lock ourselves to a transition that lasted for 1 year. Actually, I had started working in something else while I was running that transition, so really hectic. But I think overall, in a context in which we were running out of our core asset or our core supply, which was capital, I think it was a very good deal for all parties involved.
Yeah, yeah, some people are, I think they obsess over the numbers and that stuff, which that part's not really important to me because I don't think that really governs the person's lifestyle post-exit as much as the terms do. And so you got something and then you got a job. And in that, what did you what did you experience of, because you were a co-founder, then you were running your own ship, and it sounds like it was a rocket ship, like it was just gone to the moon. And then you felt some friction, and then you sold and worked for the choir for a year. Like, how did you feel on the backside of that exit?
I mean, the first thing that I was scared of and worried about is what next, right? And I spent some time, obviously, very busy with the transition and making sure that everything worked. And while I was mentally busy with that, it was all fine. But then the point to me was, okay, fine, but then I should do something with my life. And what should I do? Should I just keep operating a business for someone else? Should I start something else? What type of thing I want to achieve going forward, right? I was a little bit, I had a little bit of PTSD with raising capital. This was a very capital intensive business. We raised money from VCs. We were like 30, 40 million from VCs. Then we raised a debt facility, 100 million. And so I spent probably 4 years fundraising, fundraising, fundraising. And I was very clear that was something that I didn't want to do. So it was such a big relief when that came to an end. But then on the other hand, I missed the part of, I want to be the operator, or the boss of myself, right? And run my own shop again. And that's probably my struggle in the first year after the transaction.
So tell me more, right? The When I'm in workshops, I pick with people and they're like, if I exit, it's hard for me to introduce myself because I don't know what to tie myself to. This question of what's next for you, did it just kind of hit you all at once? Was it just kind of a quiet voice that kept getting louder and louder? Like, how did you come to the place where you're like, I need to figure out what I'm gonna do next? And, luckily you did it post exit, but still in the transition phase while you were working for the acquirer.
Yeah, I think it was a voice that kind of hit me immediately, but I initially parked it aside because I was quite busy running the transition and making sure that everything went smoothly. So that kept me busy for a while. But then, as my business started to be perhaps, or my contribution to the business started to be less important, then I started really paying attention to that voice, right? And trying to figure out what to do next. And the first thing I considered, to be honest, was going back to perhaps being a CFO, being a manager for someone else's business. I was going to say retiring. Obviously, that's not retiring, but retiring from the grind of building your own business, right? And trying to just take a salary and having that peace of mind. And I somehow thought of that for quite a long time until I realized that ultimately what made me happy is operating and taking the lead in building things and creating stuff.
So I imagine needing to raise money so that you can deploy the capital so that you can make interest on the money that you deployed was stressful a little bit. And then you got the whew, I don't have to be out here finding the money. And then you're like, but wait, I still want the buck to stop with me. Is that like
That's
the
exactly the
experience?
story. I would say capital raising was, on the one hand, obviously it was a core work stream of my business because it was. I mean, without capital, that business was just couldn't run. But on the other hand, sometimes it felt like a distraction, right? I wanted to make sure that we were underwriting customers the right way, acquiring customers the right way, figuring out the platform and making sure that the product were really smooth from a user experience. All those things, I didn't have much time for that, and that was a little frustrating, right? So that's when I came to the conclusion that maybe my next company should not involve fundraising or shouldn't be that asset heavy, and it should be something that I should bootstrap, right?
And so is that what you decided to do?
And that's what I'm doing at the moment. I started L40. It's actually an M&A advisory firm. So in a way, I am an advisor, but at the same time, I'm a founder of another platform. And what's interesting is that I'm being able to hire people, make them grow, train them, figuring out what processes we should use for being most efficient, rather than the pure advisory thing, which I enjoy and I love working with founders and helping them. But I would say I enjoy more the part of running the business and running the firm.
Tell me more. You dropped in peer advisory, and that makes me think of Vistage and EO and some of these other places. Give me some more on. how peer advisory versus what you're doing are different?
We're running a shop of sell-side M&A advisory. So whenever a founder is ready to exit, we will help them sell their business. That's the core product or the core service that we offer. So that means running a process end to end, helping them with the marketing materials, financial projections, reaching out to the buyers and building a buyer list, all those things that a banker does.
Did you use the M&A advisor for your deal?
No, we exited to a very close partner of us. We knew them really well, and it didn't make sense for us to use an M&A advisor. I think an M&A advisor is useful when you want to maximize your opportunities, when perhaps you don't have that much stress in terms of runway, and yeah, you want to run a competitive process. That's the core value of an M&A advisor.
So how did you get exposed to that, or how did you decide that that was your next?
Well, it was really natural for me. I started my career in banking like some 20 years ago. I was at Merrill Lynch for a couple of years. Then I worked in private equity. So I've been doing deals for almost my whole life. I was at Cabify when I was a CFO. I was just, again, raising and structuring debt and equity, put together that. Then same thing when lending. So I've been doing this for my whole life, and it's probably the thing I'm most competent about, and so I'm happy to help founders with this. I thought it was, to be honest, low hanging fruit in terms of my own skill set. I was also dragged into that space because we lent on some founders that were acquiring businesses, so somehow we were already within the whole M&A landscape or SaaS M&A landscape, which is essentially what we do. We're in the B2B SaaS space mostly. And so it felt like a very natural next step for me. I joined forces with two people that were in the team that are now my partners. So we're three partners at the firm. And it all came pretty natural, I would say.
I imagine you've designed a process based on your experience, Juan. Like, can we talk about some of the people you've helped and like why maybe they went with you and how your process is different?
Sure. I mean, we've been doing this for a couple of years, and I would say our track record is between 10 and 15 exits, right? Um, I would say the process tends to be pretty similar, but you need to tailor it a little depending on the underlying asset that you're selling. But mostly you start with, first of all, making sure that there's a fit, and that's the first thing. You need to make sure, if you're a founder, you need to make sure that the advisor is a fit for you, and there's alignment in the valuation that you're expecting, that the banker is going to be able to convey the equity story to potential buyers and potential bidders, so they should be knowledgeable of your industry, and the other way around, right? The advisor needs to make sure that they are taking mandates that they can execute, right? Because there's a big opportunity cost. So that initial stage tends to last, say, 1.5 months before you even sign an engagement letter. And that's when you start working. It's a very tailored process. It can take between 6 and 12 months. We involve a small team of 3 people. You got the junior guys running, crunching numbers and building materials, and then the senior people providing their contact network and obviously their expertise and making sure that the equity story is crafted in a way that is appealing considering current market conditions. And then you just go to the market with the buyers that are potentially fit for that business. That generally, that preparation stage can take another maybe 2 months. And then it's like an auction. You run a competitive process, you give buyers a deadline to present offers, you put them side by side, create competitive tension to make sure that you optimize the price. And once you're ready to go, you generally sign exclusivity with one of these bidders and proceed to due diligence and closing, which tends to be also somehow painful for the founders and the sellers. but we are also, hand holding them through all that part as well, and making sure that there's the least friction possible.
You said something, and I thought you were gonna go deep, and you went right into like, here's the boom, 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 process, process, process. You said you need to make sure that the M&A advisor is a fit. What does that mean in your world?
I mean, it means both ways. First of all, you need to have some degree of connection, right, between the founder and the advisor, because you're going to spend a lot of time working together, and it's pretty much like hiring someone. You don't want to hire someone that's going to be a pain in the ass. And same on the advisor side. You don't want to be a founder. You don't want to work with a founder that you don't connect with. So I would say that's the first thing, the personal angle. Then second, obviously, experience in your industry. That's very important, because in the end, the advisor learns a lot from the deals that they execute, and so that learning experience is applicable to streamlining future mandates. So if for example, we very recently sold a company in the healthcare space in Chile. And we learned a lot about who's active in the industry, who's acquiring, who's not, what type of thing these buyers will want to see, and so on. And that serves us to acquire additional mandates in the healthcare vertical, maybe in different geographies. And that's something that we're working on. So that type of thing is something that you want to make sure as well, the type of experience that the advisor is bringing. And stale experience, like, fine, it's okay if they worked in healthcare deals 10 years ago, but that's no longer useful. You take a look at very recent experience in the past couple of years to make sure that they're the right fit for your business. And I would say the third thing, and again, goes both ways, the size of the potential exit is very important, because in the end, you would have a hurdle in terms of fees that you want to charge. And if the deal is too small, it won't make sense. So you have to find the right fit for you in terms of deal size. Plus, obviously, making sure there's an alignment in terms of valuation. We always provide a valuation. It's generally a range, and we want to make sure that range is within the seller's expectations or the founder's expectations. Because otherwise, it doesn't make sense to waste our time, the founder's time, the buyer's time, and so on.
Do you guys spending any time talking to the founder about what they want to exit to, or what problem they're hoping the exit will solve for them?
Totally. Because in the end, that also conditions the way you run the process. And the way we build potential bidder lists is really tailored to the needs of the founder. So sometimes founders will want to continue running the business, but they have some shareholders in their cap table that they need to clean, and they need to provide an exit for. But they're not looking to sell 100%. They're just happy with running their businesses. So that's one scenario in which you would seek financial sponsors rather than strategic acquirers, which in the end tend to be less appealing for someone who wants to continue running the business. Whereas if someone is looking for a clean exit, then you could also look into financial sponsors, because sometimes they're able to bring or transition into new management after a couple of years, and strategic acquirers. And so that's a very important part of the conversation. What your goals are. Do you also want to cash out a little maybe, or you want to just keep your stake? That's the type of conversation that we have a lot.
Do you ever have people come to you and you're like, you're not ready?
All the time. But that's a blessing, because in the end, that helps us engage with people very early on. So for example, we're seeing people getting back to us right now and saying, you know what, I think I'm ready to sell now, even if I wasn't 1 year ago. And we've given them the hints and ideas on how to get ready, right? One of them is obviously achieving a certain size, because in the end, the bigger the company, the higher the multiple, and the larger the potential buyer universe is going to be. So it's much easier to sell a company with 10 million in ARR than a company with 2 million in ARR. I'm not saying it's not possible, but it's obviously much easier. And then the other thing, we generally try to kind of give them guardrails in terms of metrics, right? You're not ready because you don't have Rule of 40. Rule of 40 is a key metric in today's market, and buyers are looking to see Rule of 40. Your customer retention perhaps is not that good. We might have to go through your numbers and skim a part of it, but anything that you do to minimize churn will help you land an exit. And also, in general, is your company mature enough to undergo due diligence and be part of a larger organization? So those are the type of things that we like to talk about early on, right? Because in the end, I prefer that than having a founder that is 6 months runway, and then if they don't sell now, they're going to go out of business, and it's much more difficult to intervene there and make sure that we're optimizing the exit.
You mentioned the rule of 40. I'm not sure everybody's familiar with that. Is that a SaaS term?
It's I would say it's a general tech metric. It's EBITDA margin plus revenue growth year over year. And so if your EBITDA margin is 20% and you grow in 20% year over year, 20 plus 20 makes 40. That means that you're in the realm of businesses that are healthily growing while at the same time being profitable. On the other hand, if you're growing 60%, then that means that you're able to sustain a minus 20% margin. So that's the type of thing. If you're spending money, it means you have to be growing. If you're not growing that fast, then you have to be profitable, and both things need to add up, right?
Profitable growth escapes most founders. This is interesting.
I mean, obviously, profitable growth is the best scenario. If you're able to get to rule of 40 with 10% EBITDA margin, 30% growth year over year, that's fantastic. That's probably the best combination that you can find. And if you grow faster than that, even better. But if you're growing faster than 40% year over year, then you can afford to be negative in terms of EBITDA.
So one a founder comes to you and he's like, "Hey, I'm ready to sell my company." I think you at some point you say, "Hey, well, what are you going to do next, and what do you want out of the deal?" And they tell you, "I don't know. I just want the money," or they say, "I just want the money." Is that somebody that you're ready to move forward with, or do you do some more digging or send them to do some homework?
I mean, that type of people, what generally they need is some coaching, right? And trying to figure out what they really want. If they came to us and they say, I just need the money, it's obvious that they need something, right? They need to get something out of the business. They need a change in some way. But sometimes it could be a loan against their equity. So it's something that we don't do because they just need to cash out for personal expenses or whatever. Or sometimes it's just that they're completely burned out with the business and they need a manager, but that doesn't mean that they need to sell it. It's just hiring someone. So we want to make sure that all the pieces put together make sense, and there's the possibility that we run a process and we end up in an exit that is satisfactory to the founder. And that outcome is not achieved by other, I would say, easier means. So that's one of the first things that we challenge. Hey, you're burned out, fine, but why don't you just hire a CEO and you stay in the background and try to make sure that this guy's running the business really well, and perhaps you want to found something else, extract some money from the business. That's a very valid way of exiting without exiting, right? But no, sometimes it's like, no, you know what? I want out in all possible ways. I've had too much about this business. There's so much risk involved, and I don't feel I can cope with it anymore. I need to cash out and I need to leave. And that's the outcome that we're able to provide.
So, have you ever had a founder sabotage the deal?
It happens. It happens more often that you may think. But we want to make sure the chances of that happening are minimal. And that's why before signing an engagement, we speak a lot with the founder. And in the end, think of running a business for 10, 15 years, and then you sell it, and then you don't know what to do next, right? So understandable that something in your mind, something in your subconscious mind is willing to sabotage that deal so you can continue, with your routine, even if it's a routine that you can't cope with anymore, right? So that we want to always make sure that before we run an engagement, spend a lot of time working, figuring out who the buyers are, and engaging buyers and bringing deals to buyers. We want to make sure that there won't be sabotage in that aspect.
And so, how do you make sure that the founder isn't going to get cold feet? Because I get brought in a lot when they think the deal is done and it's not, because the founder is like, well, what am I going to do? Because they didn't answer that question before they
Yeah, you
got
have to
to the
speak a
finish
lot
line.
with them. You have to speak a lot with them. First of all, obviously, getting alignment in valuation expectations is very important. If the guy says, "Look, I want to sell this business for 10 times revenue," and we see that the market is paying 3 times revenue, then there's no possible alignment. It's like, fine, but I don't think we're going to be able to achieve an outcome that you're going to like. Uh, so that's one thing, and probably the most important one, because when someone is looking to exit, valuation is probably one of the key components of, once you have a check that satisfies what you have in mind for your business, obviously you're more inclined towards closing a deal, right? That would be the first thing. But then second, we also assess, the business from, or the I would say the founder from a holistic perspective, right? And we have a lot of conversations about, what you want to do next. Would there be a second line of management that can take over and run a smooth transition? Would you be open for a transition? And by running all those questions, you learn a lot about the founder, the thinking, their state of mind at that point in time. Very important to spend a lot of time with them.
Are there certain signals that you're looking for when you're spending time for them?
There are signals. I would say one interesting thing is that we've been founders. You've probably seen a lot of bankers out there. Many of them have spoken to many founders, and they're obviously savvy about that. But we have been founders ourselves, and we've been in their shoes. So I guess it's easier for us to see signals. But I would say core signal is if they have investors that have been around for like 5+ years, chances are they will be pushing for an exit, and the founder will reluctantly have to agree to an exit, because in the end these guys need out, and that's a part of the business model, I would say. Then in the founder, in the end, the signals are: has he hired a CEO? If there was a recent hire of management team, it seems that he's been thinking of an exit for a while. I would say engaging with them like a couple of years ahead of even thinking of an exit is really good, because we see how their state of mind evolves over time. And so that's really helpful for us to find these little signals that both the company and the founder might be ready for that exit.
Knowing what you know now, would you have done anything different as it related to your exit?
I mean, quite a lot of things. I think I should have started planning earlier on. In the end, I wouldn't say it was a fully distressed sale, but it was close to a distressed one. So that's something that I always recommend. You shouldn't be thinking of an exit when you have like 3-4 months of runway. You should think of an exit when you're profitable or breaking even, or have like 18 months of runway, so that you're not going against the clock in a process that per se is really stressful. And so you have the opportunity of perhaps engaging an advisor and running a proper process, and maximizing the outcome for everybody.
I think prior proper planning leads to a better outcome, especially if you have the right people around you. And I watch so many founders take this thing that's inevitable, because 100% of founders will exit, and treat it as if it's a lottery or it's happenstance. Have you found that some of the people who come to you think there's going to be a line wrapped around the building ready to buy their company, and you find out that there's only a handful of people that are interested, or maybe only one or two?
I mean, most founders tend to think highly of what they build for obvious reasons, right? And they think that the business is worth a lot, but they also think that the business is interesting for many people. And it turns out that many companies are healthy, are good at what they do, but they're not an M&A target per se, so it's not easy to sell them as such. Either because they're founder dependent or because they're in a sector that is not attracting investor interest these days. So all those things are yeah, things that founders need to think of, and obviously talking to an advisor helps a lot for understanding whether the market is ready for the company or not. But yeah, pretty much everyone thinks that if they want to exit their business, they can do it pretty much anytime, and they will get plenty of offers on the table.
Sounds like that's not true.
It is not true. It is not true. I would say, we sold a marketing tech company in 2025. Very healthy exit, really good multiple. The founder was really happy. And then 6 months afterwards, the market is not taking a single marketing tech company anymore because of AI and all the changes that are happening in the market. So it's definitely not true. The market has its own trends and its own ideas, and you can't fight against that. It's just a matter of timing your company with the market and finding the right time for an exit.
I guess the final two questions. The first one is how can people get in touch and find out more about what you guys are doing in M&A advisory space?
Oh, definitely. They can go to www.l40.com. L40, by the way, stands for Latitude 40. Latitude 40 North is the parallel that connects New York with Madrid. So those are the two places I've been, spending my time in most recently. And yeah, they can find all the info there.
Okay. And then the question I love to wrap up the podcast with is what's the one thing you want the listeners to take away from the episode? Because we've been all over the place from your exit to lessons you've learned with exits you've helped people move through. What's the one thing they should take away?
I think you're always very busy with operations, but from time to time, giving it a thought in terms of what you want to achieve, where your business is going, where your business is headed, what you want to do with your life. Those type of thoughts are really important to kind of take a step back and strategize a little, because you will never know when the timing is right, but you always have to be prepared. So thinking of how an exit should look like, what you want to do next, and what a good outcome for you is something that from time to time you need to dedicate time to.
What you want to do next? What's an ideal outcome? And what's the first one?
What you want to do next, what the outcome is, and when or how you want to exit, right? And kind of planning ahead of that.
I love it. I think if you can figure out those three things, you're a whole lot further ahead than most people as it relates to exit planning. Juan, thank you so much for joining us on the episode today.
Thank you, Jerome. It was my pleasure.
To our listeners, your dreams should be real. We'll catch you on the next episode.